Welcome to our channel. Accounting is a big part in every business. It's like the main part to watch over the money that's coming in and going out. It's really important for making decisions about money. Without good accounting, we won't be able to tell how a business is doing with its money. Now, in accounting, there are some special rules and ways of doing things that everyone must follow. These are known as accounting principles. They are like the basic steps we need to make a good financial report so everyone can understand it the same way. We must know the rules to write down what happens with the money correctly and to look at the financial reports in the right way. In this video, I have cleared all about these accounting principles and why they matter so much when we are looking into the financial side of a business. It's like learning the ABCs of money management in a company. There are several important reasons why businesses need to follow accounting principles. Firstly, these principles help in keeping the financial records clean and organized. This makes it simple for everyone to grasp the company's money situations. They ensure that all the figures are consistent and have a logical flow. The main reason for using these principles is that they assist in preparing financial statements that are all inclusive, regular, and useful. These statements clearly outline our cost, earnings, debt, profits, and what we own versus what we owe. This is important because it lets us monitor our funds effectively and make wise choices about spending. These principles allow us to compare our financial data with other companies. It's like having a business report card that shows how well we are doing compared to others. This comparison is essential for investors and other interested parties to evaluate our performance. These principles also promote transparency in finance. This means that it becomes more difficult for anyone to mislead investors by hiding important information. If someone fishy is going on, these principles make it easier to identify and address the issue. Accounting principles are like a guide for investors to understand our company's financial health. They enable investors to analyze our data and decide if investing in our business is a good choice. Let us discuss about the principles of accounting. Accrual principle. The accrual principle is in accounting that tells us to note down transactions when they take place, not when the money moves. This way, we can see how a company is performing money-wise. Most large companies use this method known as accrual accounting, which shows income and cost at the same time. This helps compare companies and is required for taxes. Consistency principle. This principle is like a rule book for keeping financial records. It says that once a company picks a method, it should stick to it. This makes it simpler to understand and compare the financial health of different companies. But sometimes errors can occur when people handle data differently. So companies should have a standard way of doing things to prevent mistakes. Conservatism principle. The conservatism principle is about being careful with money. When there's doubt, always go with the lower amount. If you are not sure about expense or what you owe, record them early. But for income and what you own, only record them when you are sure. This principle is the basis for the lower of cost or market rule, which means you write down the lower value of your goods, either what you paid or what it's worth now. Cost principle, historical cost. This principle is like keeping a diary of what you paid for things. When a company buys something, it notes down the price and keeps it that way in its books. Even if the value changes in the market, the recorded value stays the same. This is known as the historical cost. It helps companies understand the real cost of their assets and is used to calculate their financial health without considering market changes. Economic entity principle. This rule is like saying that when we talk about money in business, we should think of companies as if they are separate people. So all the money related stuff that a business does should be kept apart from what the people who own it do with their own money. It doesn't matter if you are running the show alone, with friends, or as a limited company. Your business finances should be separate. Matching principle. Now, the matching principle is like a special rule in the bookkeeping game called accrual accounting. It says that when a company tells us about the money it spent and the money it made, it should do it at the same time. This helps investors see how much money the company made after paying all its bills for a certain time, like a month or a year. But wait, there's another important thing called the cash flow statement that investors should also check to get the full picture of the company's money situations. Materiality principle. This one is about being honest and clear in your business's financial reports. Companies have to put all the important informations in there that could help someone decide if they want to invest in the company or not. But only the big and important stuff counts. If someone is too small to make a difference in the way someone sees your business, you don't have to put it in the report. But if it's something that could change their mind a lot, then it has to be there. It's all about giving investors the real story without confusing them with teeny details that don't matter much. Full disclosure principle. This guidelines tells us that all businesses related details must be in its financial statements. Even if something seems small, it should be there if it could change how investors think about the business. But we don't write down stuff that can't be counted or measured in money. Also, companies have to let investors know about how they count money and if they change their methods. Going concern principle. This principle says that a company should keep doing businesses unless there's a solid reason to stop. It should keep earning money and paying its debt until it has to close for good. The main aim is to not go broke. If a company can't do this, the chances of its closing down become really high. It's vital for companies to plan ahead and ensure their financial health is always good. Monetary unit principle. This rule tells us that everything in a company's financial papers should be in rupees for India. We can't write things that can't be turned into cash or don't have a money value. First, we convert everything into money. This makes it simple for everyone to understand because it's all about money. Reliability principle. This guideline wants all the information in a company's financial papers to be trustworthy. It should be based on real facts that can be checked and verified. No hiding anything. It needs to be correct and clear so investors can trust it and make wise choices. Basically, it ensures that the financial records and statements are always right. Time period principle. In accounting, there's this important thing called the time period principle. It's like a rule that businesses should tell everyone how they are doing money-wise in set chunks of time, usually every year. This helps because then people can see if a company is getting better or worse over time. Like a school report card, companies show their financial progress every few months or once a year. This helps everyone keep an eye on how they are doing. By looking at these reports, we can compare how a company did this year with how it did last year. It's like comparing your exam scores to see if you are improving. Even if a company hasn't gotten the money yet for something it sold or hasn't paid for something it bought, it will still write it down in the books. This way, the reports show what really happened in that time, not just when the money came or went. The big important reports come out once a year. These are like the final exams of a company's financial journey. They include the income statement, balance sheet, and cash flow statement. Revenue recognition principle. Now let's talk about when to count our money in business. This is where the revenue recognition principle steps in. It's like a guidebook that tells us to count our revenue only when certain things happen, usually when the customer pays us. But sometimes making what you sell takes time. You don't want to count the money too soon or too late. That's when this principle matters. Objectivity principle. This principle is all about keeping things fair and square in the financial world. It's like saying, look, your financial reports should tell the truth about any drama or bias. It's super important because it makes sure that everyone sees the company's financial health the same way. Imagine you are an auditor, like a detective for money matters. You need to be able to look at the books without any personal feelings or favors. If you have been working with a company for a long time, it might be hard to be completely unbiased. That's why the objectivity principle is there to keep everyone honest. It helps ensure that the financial reports are as close to the real story as possible. No sugarcoating or hiding the bitter truth. It's all about being fair and keeping everyone's trust in the accounting game. Accounting principles also have some limitations, like they only look at the money side of things, so other important stuff without a price tag might get ignored. For example, if your company does something really good that doesn't cost money, accounting might not think it's important because it's not in the money numbers. Accounting works on what you paid for something in the past. So if you bought something last year for ₹1,000,000 and now it's worth only 8 lakh rupees, they will still say it's worth $1,000,000 because that's the price you paid. But in the real world, the value has gone down. Accounting is like looking backward. It doesn't think about what can happen in the future, which can be a problem if you are not careful about planning ahead. Sometimes accounting is more about how things look in the books than what actually happening. If you need to explain something in detail, they might not give you the chance because they are focused on keeping it simple and neat. Understanding accounting is important, especially when you are starting to handle money. It helps you keep your finances in order and avoid trouble. But don't forget, there's more to managing money than just the numbers. Keep it simple and don't worry too much about the small things. Accounting principles are made to keep things clear and uniform in the accounting world. They shouldn't be too complex or puzzling. Just like our world and rules, accounting principles also evolve. As governments change laws, businesses change how they work, and people want different things. These principles need to stay current. There's no one size fits all in accounting. Principles can be different based on what's happening with your specific business. Now let's go over the 3 key things to remember about accounting principles. The principles are only good if they give the right details to the right people at the right time. They must relate to your business and be useful to those who rely on them. They should be flexible to adjust with changes in the market or outside factors. This way, your accounts stay correct even when the world around you changes. When you put numbers in your accounts, it should only be based on real facts, not what you feel or what others might want. This keeps everything honest and trustworthy. So these are the main points about accounting principles. Let us discuss about accounting standards. The 2 main accounting rules we follow: International Financial Reporting Standards (IFRS) and Accounting Standards for Private Enterprises (ASPE). International Financial Reporting Standards (IFRS) are basically the big boss rules for companies. These rules are made by the International Accounting Standard Board (IASB), which is like the global headmaster for accounting. These rules are used in more than 120 countries, even Canada, to keep everyone's money books looking the same. This way, when you want to compare how much money 2 companies have made, it's like comparing apple to apples, not apples to oranges. These IFRS rules cover everything from how to show your money in the books to when you can say you earn some of it. They also talk about how to handle things like taxes, what you owe your employees, and even your office buildings or car lease. The main idea is to keep everyone honest and make sure no one is hiding money or playing tricks with the numbers. Accounting Standards for Private Enterprises (ASPE). These are a bit more chill rules compared to IFRS. They standard that private companies don't have to tell everyone their businesses, so they are more flexible. They are based on some guiding principles, which means you have more choices in how you show your money in the books. ASP makes sure that even though you are not using IFRS, your money books still make sense and are easy to read. They also don't force you to give out every teeny detail, which can be good because it means less clutter. Besides IFRS and ASPE, we have other sets of rules for special type of companies, like those that help people without making a profit, or for pension plans that take care of folks when they retire. To make sure you are playing by the right rules, you should check with the Financial Reporting and Assurance Standards website or the IASB and IFRS Foundation websites. They are like the rule book for keeping your company's money story straight. Now let us discuss about difference between accounting standards and accounting principles. People sometimes confuse these two, but they are indeed different. Accounting standards are the regulations given by organizations like ours that tell companies the correct way to show their money situations. These rules keep everything the same so that we can easily compare one company with another. Accounting principles are more like basic guidelines that don't belong to any particular place. They are not as detailed as standards but give a good idea of how to prepare a proper financial statement. Both of these help everyone to understand and manage a company's finances in a clear and organized way. Thank you so much for watching. If you enjoyed this video and found it informative, I would like to receive your support. Please give it a like, share it with your friends and family, and subscribe to our channel.